Hello, and welcome to a short video discussion answering the question, what is an HSA? With illustrated help from my friend Ben. Today's healthcare landscape is overrun with abbreviations. PPO, CDHP, PPACA. How can anyone be expected to keep them all straight? One of the more common ones being thrown about is HSA. So what is it? Well, let's start by going over what it's not. It is not a health insurance plan. The term HSA is widely used by consumers as an adjective to describe a health plan. You've likely heard someone say, "I'm on an HSA plan," or maybe you've even said it yourself. This actually is an incorrect statement. An HSA, or health savings account, is exactly that, a health savings account, not a health plan. It is an account in which you may save money on a pre-tax basis to cover your out-of-pocket healthcare expenses. So long as the money in the account is used for eligible expenses, it may be withdrawn tax-free. So that's pre-tax in and no tax out for eligible healthcare expenses. Sound familiar? That's right, it's similar to a flexible spending account. The biggest difference between an FSA and an HSA is that with an HSA, all the money you contribute and accumulate may be rolled over in the account year over year. There is no limit on the money that may be carried over. You can also put more money into an HSA than you can into an FSA. For this reason, an HSA is often compared to an IRA, but for healthcare, not for retirement. These comparisons are both valid and should give you a better idea of what an HSA is. So let's move on to the particulars. In order to be eligible to contribute to an HSA, a person must be participating in an HSA qualified health plan, or, more specifically, a high deductible health plan. Once you've established an account, you may choose how much you want to contribute, how often, or whether or not you want to contribute at all. The only contribution restriction in place with HSAs is the maximum amount you may contribute per year. This limit changes annually with inflation. In 2013, the maximum a person with individual coverage may contribute is $3,250. The maximum a person with family coverage may contribute is $6,450. In addition to these limits, a person aged 55 or older may put in up to an additional $1,000 annually in what is referred to as the catch-up provision of HSAs. Your contributions to your HSA may be made at any interval you like. You could put in a lump sum at the beginning of each year, you could put in a certain amount each month, or you could even wait to fund the account until after you've experienced medical claims. It's totally up to you. The IRS allows you to make HSA contributions for this year through April 15th of next year and still receive the same tax benefits. Another great feature of HSAs is that your employer could even make contributions on your behalf into your account if they so choose. No matter how the money gets into the account, once it's there, it's all your money. Meaning, if and when you leave a particular employer, your HSA account and its total balance go with you. Now that we've covered your contributions, let's go over distributions. As mentioned earlier, money in your HSA may be withdrawn tax-free to pay for eligible healthcare expenses. This could be doctor visits, hospital bills, prescription drugs, and even dental and vision expenses. The list of eligible expenses is managed by the IRS and can be found on the IRS website. Most HSA providers supply you with a debit card, which you may use to pay for your eligible expenses, making it very user-friendly. You may also file for reimbursement the old-fashioned way, by submitting your receipts for eligible expenses. Either way, the money is distributed from your account tax-free. It is important to know, if money from your HSA is distributed for purposes other than eligible medical expenses, you will be subject to ordinary income taxes on your withdrawal, plus a 10% penalty tax if you are under the age of 65. And that's it. That's the ins and outs of HSAs. There you go. Now you know. See ya.